If you're abusing the privilege, if you're trying to create inflation, if you're trying to destroy wealth, if you're trying to steal savings, then people won't trust you and they'll say, yes, I'll take the gold, thank you very much. So that way, that's how open market operations combined with discretionary monetary policy can work side by side using price signals, which is a very Austrian concept, to tell you, to guide your monetary policy, to tell you if you're on the right track or not. So just to summarize, it's uniform grade, it's atomic element, it's malleable, it's dense, it's got a long historical track record, it's flexible, and at the end of the day, it's tangible. If you have physical gold in your possession, you have money that does not rely on any degree of trust. If you have it in a bank, you're trusting the bank. If you have it in GLD form, or you have it on a COMEX future, you're trusting the exchange, you're trusting some other party. But if you have physical gold in your possession, you didn't lose leverage to buy it, so the bank can't come and take it away. That's money with no element of trust of any third party. It's the ultimate form of money and the foundation of all other kinds of money. So, Roman, I'll turn it over to you.
So, I believe in gold. I own a little bit of gold, but I'm gonna live up to my responsibility and try to tell you why Bitcoin is better. But I think they're both great. First, I'm gonna argue about physical gold, and then comment on electronic representations of gold. And when I argue about physical gold, I'm reminded of a joke that was told by Guido Holzmann, who many of you know, at an economics conference that I attended. And the joke involves an economist, a physicist, and a chemist washed up on some desert island with a can of beans. And the physicist said, let's smash it open. And the chemist says, no, let's heat it until it pops open. And the economist says, no, I have a better idea. Let's assume we have a can opener. So I think the argument for physical gold has a similar assumption embedded in it. It kind of assumes that we have a free market for money, and that, you know, if you want to just go and trade these gold tokens, or if you want to take them across borders, or do whatever, you know, use them however you want without anyone's permission, that will be allowed. But it's not allowed. Bitcoin is very much a reaction to the state and the state's impositions on money, and Bitcoin's advantages over physical gold to me seem fairly obvious. You can transport it anywhere in the world almost instantly for free. It's easier to verify it. There have never been fraudulent Bitcoins. It's more divisible. You know, if you're stuck with you know, I have 1 ounce gold coins. You know, I'd have to have some intermediate money, like maybe I would trade it for a whole bunch of cigarettes, and they'll deal with the cigarettes when I want to buy coffee for gold. But Bitcoin lends itself perfectly. Every Bitcoin is divisible down to 8 decimal places. And we heard that physical gold requires no trust. Sort of. I mean, you're trusting society against, you know, physical aggressions against your property. Whereas it's easier to hide Bitcoin than it is to hide gold, and it's easier to transport Bitcoin than it is to transport gold. So in some ways, Bitcoin requires less trust than physical gold. But I think the more interesting comparison is to talk about electronic representations of gold, which have existed in the past, back when entrepreneurs were allowed to do them. And I think the biggest rival to Bitcoin will come, I hope it comes in my lifetime, but it'll come when the fiat system is dead and buried, and entrepreneurs aren't afraid of engineering gold to behave like Bitcoin. Then you can do with gold everything that you do with Bitcoin from the user's point of view. You could send it across boundaries for free and trust that some company is just keeping the accounts accurate in a vault somewhere far away. This is how e-gold functioned before all their gold was seized. It was one of the largest seizures of physical gold ever. But even then, there is still a case to be made for Bitcoin, because I don't know if their e-gold's vaults were in Costa Rica or somewhere in the United States. I don't know where they kept it, but that's still a physical risk of someone coming in and taking the gold. No such risks exist with Bitcoin. You're still trusting a third party if you use electronic gold, whereas Bitcoin is person to person, no third party whatsoever. E-gold had an annual peak of about, in their decade of existence, the most annual transactions were about 1 billion, and that was right before they were shut down. Bitcoin is already doing 200 million a day. So if you add that up, it comes out to like 7 trillion something. So would somebody trust a business, electronic gold business, enough that they would build additional software and internet infrastructure to support the exchange of their currency? Bitcoin is a protocol and it has no owner, and that's very attractive to software developers. And I think that's why there's so much more action on Bitcoin than there ever was with e-gold. Relying on that third party also creates the potential for a Google Reader problem. A Google Reader was a very popular reader that people would get their news from, but it belonged to Google, and one day they decided they wouldn't support it anymore and they shut it down. Why would programmers build infrastructure on top of the next e-gold when it's controlled by someone? I'm not saying they won't. I'm just saying that even in such a situation, there's still a case to be made for Bitcoin, which would not belong to anybody and which would be peer-to-peer with no trusted third parties. Last point I want to make. Most of us believe, or at one point believe, that money should be a commodity. But I think even more fundamentally, we believe that markets choose their money. Markets choose their money. And I think when we see the flight from the dollar, that network effect that we saw, in the earlier presentation, I think the door is wide open for Bitcoin in a way that it is not open for gold. I don't know of any restaurants that accept gold. I don't know of any place where you could buy electronics for gold. There's a libertarian conference that happens every year in New Hampshire called PorkFest, and they really try to live absent the state. And with that in mind, they used to trade in silver. Their little bazaar that they set up. This is a very small anecdotal example, and I may be guilty of a confirmation bias, but they had a little market at this conference every year where they traded in silver. This past year, no silver whatsoever. It was all in Bitcoin. So I'll leave it at that for now.
We'll do a few minutes of rebuttal and then back over to Roman for the last word. So this conference is called Intellectual Minds, which implies a certain broad-mindedness or open-mindedness. And I think Roman is definitely a lot more open-minded than I am, because he said he owns gold and Bitcoins, and I own gold. So he's, I think, a little more forward-leaning in that regard. A couple things about Bitcoin specifically. One thing that's overlooked is that is Bitcoin a form of money? Sure. Is it a kind of money? I don't dispute that. But it's not state money. And here we have to go back to the state money theory, which has really evolved in Germany in the early 1920s, later called chartalism. Today runs under the banner of modern monetary theory. But it says that money derives its value from the fact that the state can require it in the form of taxes under pain of death in the extreme case. And so the problem with Bitcoin is if you buy your Bitcoins for $100 equivalent and you cash them in or exchange them for $200 of goods and services, under certainly US tax code in UK, and I think most countries, you have a $100 gain in that example. You bought the Bitcoin for 100, you swapped it for something that was worth 200, you have a $100 gain, leave aside whether that's ordinary income or capital gain. You have to put that on your tax return, and you have to pay dollar taxes on the gain. I dare say that there are practically no Bitcoin users in the world, exception of Roman, who are actually tax compliant, who are actually doing this on their tax returns, which means that all the Bitcoin users are tax evaders, which is a felony in most jurisdictions. For people who don't think that the government's watching, I would refer them to a gentleman named Snowden, I think now residing in Russia, who has told us enough about the NSA capabilities and their encryption capabilities and decryption capabilities. We also have an IRS scandal in the U.S. which shows that the IRS has been perverted to do selective politically based enforcement. So I think what's going on is that between the NSA and the IRS and organs of the U.S. government and the Inland Revenue and your general headquarters, I think is what they call our equivalent of the NSA, are watching all this. And someday, sooner than later, hundreds of thousands of people, if not millions of people around the world, are going to get deficiency notices from the tax authorities saying, we've observed the following transactions. We've also observed that you didn't put this on your tax return. Come in and give us an explanation. Of course, you're all felons at that point. And if you happen to be on the wrong side of the political divide, you might be subject to incarceration. So that's coming. Just kind of put that down as a warning and one reason to think hard about Bitcoin. I'm actually very serious when I say that. The other thing is that I talked about anything being a form of money. By the way, we're all familiar with what's called the straw man argument, where you create a straw man so you can go knock it down and say, see, I knocked down that straw man. I thought it was interesting that Roman spent 2/3 of his time talking about the deficiencies of e-gold. I never mentioned e-gold. I don't advocate e-gold. Roman basically put up a straw man that he attacked. I'm not talking about e-gold. I'm not talking about COMEX futures. I'm not talking about GLD. I'm not talking about ETFs. I'm talking about gold. So gold is no one's liability. I think no one's done a better job than the Austrians of pointing that out. It's the only form of money that's not a liability. You say, what's a dollar or a pound sterling? I learned in the first week of law school, if you have a contract, you're supposed to read the contract. Again, I'm familiar with dollars, take a dollar bill out of your wallet, or take a pound sterling, and look at what it says. Look at the writing, that's the contract. It says it's a note. It's a Bank of England note, or in the case of US dollars, a Federal Reserve note. Where I went to law school, a note is a liability. Indeed, if you look at the balance sheet of a central bank, the money that they've created is listed on the liability side of the balance sheet. So it has no interest and has no maturity, but you can think of money as a perpetual non-interest-bearing liability of a central bank, and these days the central banks are actually insolvent. So there, the amount of trust in using that as a form of money is extremely high. And the reason clamshells and feathers and other media of exchange were accepted as money was because others in the system trusted that they had value. I would take a clamshell as money because I trusted that when I wanted to spend it, somebody else would take the clamshell as well. That works fine in communities. It works fine in tribes. It works fine on a limited scale where the trust is high. But the minute you broaden the community so that you're no longer in direct contact with people, you're relying on a degree of trust that may be misplaced. So Bitcoin is really a global community at this stage. I expect that will grow. But you're trusting Sakamoto, whether he was an individual or a team, whether he was working for Google, we're not quite sure. But the creators of Bitcoin, we don't know that there aren't so-called trapdoors or hidden aspects of the code. In open source, you probably ferret that out sooner or later. But finally, the ultimate trust is that when will you want your money the most? Let's call it your store of wealth, and let's refer specifically to gold. When will you want it the most? You'll want it the most when society is at its worst. In other words, if things are good, somehow the Fed stops printing money and the dollar stabilizes. By the way, I'm often labeled as a gold bug. I'm actually not a gold bug. I spent a lot of time reading and writing, researching and talking about gold. I'm a bit of an old school imperialist. I favor a strong dollar, the so-called king dollar policy. The problem is it's not what we have. I may favor it, but my preference is irrelevant. The policy of the United States is to weaken the dollar. That's why I lean to gold. But at the end of the day, if society actually collapses, your gold will be money good. And by the way, there's a role for silver as well, not to change it up, but that's an answer to the denomination problem. I recommend people have what we call a monster box, 500 1-ounce American silver eagles. So you think of silver as fractional gold, so you don't have to sit there with a file and kind of chip off little pieces of your gold coin, because I agree that a gold coin in that world is probably a year's worth of groceries, not a week's worth of groceries. So there might be a role for silver there. But at the end of the day, you don't have to trust anyone to find your value in gold. And Roman talked about Bitcoin being kind of outside the power of the state. that really is wishful thinking. The state is watching, they're waiting for you, they control the portals. You probably, if you're a Bitcoin user, you're probably a tax evader. And last time I checked, the state runs the power grid, and good luck with your Bitcoins when the power goes out.
It was some hacktivist, Mark Amberg, if I remember his name. I think I have his name wrong, but he said government may be a violence on monopoly, but violence can't do math. I think Bitcoin is outside the control of the state. The role of the state is not. It has a huge impact both on the price and the usage of Bitcoin. All the big companies in America, Amazon, Google, Apple, they're waiting to see what the state will do. The recent drop in the Bitcoin price from about 1,200 to about 700 came after the Chinese version of Google, like the Chinese equivalent of Google, said that they would stop accepting Bitcoin. They did that after the state sort of limited the legal usage of Bitcoin. So it has a huge impact, but I think it's just a question of whether it's going to be a white market or a black-gray market. And certainly if the dollar starts to go, you want to be in the black-gray market. I mean, just to pay the, inflation, like if there is serious inflation, your taxes will go through the roof, because if you buy something for a day and sell it tomorrow, it will have doubled in price. So it's not irrelevant, but I think it is outside the control of the state. What they do now is they watch the exchanges. I buy my Bitcoins, the most recent ones, on an American exchange where I'm registered with my name and bank account, and I have warned my accountant that I will be about all that. But those are just the choke points into and out of the Bitcoin system. And because the choke points are guarded, most people want to stay in Bitcoin because they don't want to pass through those choke points again. They want Bitcoin so they can exchange without having to ask the permission of any bank, without the approval of any state. And I think that's why it's going to spread. There was one more thing, power. Oh, right. Well, I think without power, the legacy, what I like to call the legacy banking system, maybe that's wishful thinking, but I think without power, the legacy banking system will be out of luck just as much as Bitcoin. And when the power comes back on, the blockchain is still there. So I wouldn't worry about that. And I think that's mostly it. I mean, I guess the amount of time I spent on e-gold was just because I thought the advantages over physical gold were fairly obvious, more transportable, more verifiable, more divisible. Maybe we should want to take questions now. Maybe that'll trigger some more good discussions. Okay. So maybe please ask which one of us should answer the question. And then ask the question, and we'll share the mic. Yes, sir.
Thank you. Hopefully you'll be able to enlighten me just on a question I have. First of all, as many of you will know, Carl Menger wrote a book on the origin of money, and he, in his theory, which Mises then built upon, was that money has to have its origin in the marketplace as, two important words, as a consumer good. So both of these two words are important. Consumer, as in it is purchased for a reason in and of itself. So all the different types of money in history had a consumer good. Gold was worn as jewelry. But also as a good. And Menger also defines good as having four characteristics, the most important of which is scarcity. So I have a question with regards to the scarcity of this digital currency. Not that we all understand that it is mined and it is released at a certain period of time, but the fact that what makes Bitcoin scarce is its uniqueness, in that it was the first digital currency to be released, as far as I'm aware. But what is stopping multiple other new digital currencies being created?
Okay. Well, you don't have infinitely many, but there are hundreds. I think there's around 200 or 300 alternatives to Bitcoin. They're collectively known as altcoins. And they've been a great playground for experimentation. One of the funniest ones is called Frycoin, which I call Keynesian coins, because its creator had the idea that you need to spend your money or else it's bad for the economy. So they depreciate in value if you hold on to them too long. Others are tied up with, one can be a new protocol for the ownership of domain names. There's one called Namecoin. Right now, if say the government wants to seize the domain propertyandfreedomsociety.org, if it was propertyandfreedomsociety.bit, and it's the ownership of the domains was regulated by Namecoin, they would be non-seizable. Another one is called Primecoin, and in their mining algorithms, they do something that's potentially useful for mathematics. They generate very big prime numbers for the mathematicians to play with. Okay, I'm getting off on a tangent just because I love this topic. Scarcity. Okay, right, and Menger. Okay, so scarcity. I think there are many metaphors for Bitcoin. I think one of the best ones is a big ledger, and you're renting space in this ledger. So it's not scarcity in the commodity sense, but it's maybe scarcity in the service sense. And I think if you wanted to make things like like Mises's regression theorem work with Bitcoin, you have to do a little bit of gymnastics and argue that it's a service and not a commodity. And it's a service that predates Bitcoin. You know, before Bitcoin came on the scene, I paid $30 for wire transfers from one country to another, or I paid 2-point-something% for PayPal transactions, or credit cards take their percentage. So a demand for this service does predate the existence of Bitcoin, and then Bitcoin arrives. Think of it not as a coin, but as a ledger, and you rent space in this ledger in order to use it for the sending of money. And I think that's the best way to square Bitcoin with Mises and Menger. But I'm also not sure how valuable an exercise that is, because they were very much engaged in untangling all the mediums of exchange of their day, which is why I think the colloquial definition of money is best.
Just to add to what Roman says, I actually think Bitcoin passes the scarcity test maybe too well, because it has a limit. Is it 24 million?
I think it's around 21 million.
21 million or so Bitcoin. The way the algorithm is set up, that you won't be able to produce anymore after that. Now, the problem with that is it's highly deflationary if you measure the price of goods in Bitcoin. In other words, if you cap out the amount of Bitcoin but the economy continues to grow, the value of a Bitcoin will go up enormously. So eventually, in the extreme, one Bitcoin would be able to buy an entire country with it, because the economy would have grown to the point where, the Bitcoins are fixed. So they may have to solve that problem, but it gets back to the community that Roman described. A lot of people object to the gold standard, and I would distinguish a gold standard from gold, because gold is just money, and if you have it, you have money, you have a store of wealth. But a gold standard is a system where you take a paper chit, in effect a warehouse receipt, but probably not that good, that's fixed to gold. So there's gold in the vault, and we circulate paper, and the paper has some fixed relationship to the gold, and you trust that. But the history is that countries abuse the trust. They periodically devalue the currency, they'll confiscate the gold, they'll do various things to break that trust, and that's happened over again. That's an objection to a gold standard. It's a valid objection, but you have the same objection with regard to Bitcoin. There's nothing stopping the Bitcoin community from getting together, online or in cyberspace, and consensually saying, 21 million is too low. We really ought to have 40 million Bitcoin, because that's more practical. So that could happen. It's not happening yet because we're not at that limit. But these are the kind of things when I say you have to trust the community and trust the evolution, trust the power grid, trust governments. There's a lot of trust of people you don't know that go into Bitcoin. And one of my reservations is, I'm not a Bitcoin hater. I've read the papers. I've read the papers Roman has. I'm familiar with it. I think the technology is cool. The encryption's cool. I like open source. So I say go for it. I don't own any. I don't recommend it to clients, partly because it doesn't have the kind of track record that I look for when I want to allocate wealth.
Let me just add to that briefly. The deflation problem, if you consider it a problem, is actually made worse by losses of bitcoins. You can search for losses of bitcoins and read some painful stories about people who had hundreds of thousands of bitcoins and either threw away a computer or lost their wallets or something like that. So it's actually worse. But with each one divisible down to 100 million pieces, I don't think that's a problem. And would the community support the changing of the protocol to expand to 40 million or 80 million? They would not if it would cheapen the bitcoins they currently own. But if it was a problem and people were abandoning Bitcoin altogether, then they would choose that to save the value of their coins. But that's a long way away. Yes, sir, David.
Toss a ball over the net at Jim and see how he gets it back.
Here we go.
All Bitcoin users are tax evaders on all gold.
Well, if you buy gold at a level and you exchange it for goods and services at a different level, you have to put that on your tax return. That's not what people do. What they do, no. What they do is I don't mean they don't report it on their tax return. What they do is you buy gold for dollars, and then if you need dollars, you sell the gold for dollars and use the dollars to pay your bills. And yeah, that's a taxable gain. You put that on your tax return. So I don't think it's any magic there. It's no different than buying IBM at 100 and selling it at 200. You have a $100 gain. So.
Two communities of tax evaders.
There's probably some tax evasion across the board, but I think gold is, you're in and out of the dollar system. Let me put it this way, there are very few people evading taxes in gold who don't know what they're doing. I think the problem with Bitcoin is a lot of people just haven't thought about the problem. In my experience, the followers of Bitcoin are libertarians and technophiles, not necessarily economists or traders. And so I think in a lot of cases it's just naivete.
They can't put us all in jail. Yes, sir.
I have a question for Roman in relation to what the gentleman said in mindful of the Hungarian theory of capital and currency. In your opinion, it's a twofold question. In your opinion, is exchange a consumer good, considering opportunity cost? And do you think that Bitcoin, in your opinion, is a consumer or a producer good?
Can you help me with the difference between consumer and producer good?
Well, that's why I ask you if you think a exchange is a consumption given the opportunity cost, because a producer good is a higher order good used for a final consumption good for the everyday, version.
Yeah.
And it's something that you use to attain the direct consumption goods. So would you classify Bitcoin as something to get to first order goods, or would you classify it as a consumer good in and of itself?
Well, that's a good question. The service, I would classify it the same as the service of money transmission. So however you would put that. I don't know. I would love to defer to our Austrian scholars in the room on that question, but I don't know. You did remind me of an earlier point, if you allow me to escape from that question. You mentioned Menger's definition of money being a good that exists on the market, and I was very happy to hear that, because I didn't know that he used those words. Because when Mises describes it, he uses the word physical commodity, so that spoils it right there. But I'm glad that Menger just said a good that exists on the market, because then if you want to do the mental gymnastics, you can say that it's packaging a service as a money. But I still think this is maybe not a very important game, because we're dealing with archaic definitions. More questions? Oh.
This is a tough crowd to take issue with Austrian tenants, but I would suggest that there are things in the world other than producer and consumer goods, and one of them is the rule of law. And the rule of law is civilization's alternative to violence. In other words, absent a rule of law, through most of history, wealth was created at a very, very slow pace. A little bit here and there, some from trade, some from mining and agriculture, but wealth grew very slowly. The way you got a lot of wealth was through violence. 30 Years' War, Crusades, nightly combat, the Norman invasion, you name it. But the way you got wealth, Vikings, raids, the way you got wealth is by stealing it from other people and killing them in the process. It was only really with the Industrial Revolution that we got better at creating wealth as opposed to stealing wealth. But part of that evolution on and off is the rule of law. I would put money, my definition of money would be a contractualism theory rather than Austrian theory or monetarist theory or chartalism, which is the state power of money. I would advance a contractual theory, which is really a subset of law, and saying that money is part of a rule of law and one of the ways that societies facilitate commerce and wealth creation without violence. And in that regard, Bitcoin is a form of money.
Yes, sir.
Rodman, I was going to say, Bitcoin is illegal to program, right?
Yeah, everything about Bitcoin is it's code, and any good programmer can go and read all of it. So at this point, I will say that there are no secrets in the Bitcoin code. There are no backdoors. Like, it could be that some guy with a gigantic brain is going to figure out how to crack elliptic curve cryptography, but this is that's some serious scholarly work to break that kind of cryptography. But even then, the blockchain still exists. We know who own what Bitcoin. So at worst, it's a disruption, and they'll switch to a different type of cryptography. But those are, the types of crypto used in Bitcoin, they've been under academic scrutiny for decades. Yes, sir.
How can somebody stop it from being counterfeited, from being recreated?
Oh, okay. By counterfeiting, it seems like you're referring to making a Bitcoin 2 that does the same thing in parallel. Those already exist. There are hundreds of those. But within the Bitcoin system, nobody has ever sent the same Bitcoin twice and had it accepted. Yeah. So that when I was talking about counterfeiting and better verifiability than gold, that's what I meant. Within the ledger that is Bitcoin, nobody has ever made fraudulent transactions or sent Bitcoins they didn't own or anything like that. Other questions? Great, thank you for your attention.